1.3287. That's where pound sterling to US dollar is stuck right now. The Fed has a 38% chance of hiking tomorrow. That is massive uncertainty for a central bank decision. The pair is compressing between 13260 and 13340. One of these breaks, fast 0.2 scalp setups. One swing trade. The BoE follows on Thursday. This is a central bank doubleheader. There is a 30 pip trap tightening around pound sterling to US dollar right now, and most traders don't even see it coming. 1.3287, that's where the pair is sitting as we speak, down 0.09% on the session, and absolutely nothing is moving. That silence? That is the danger zone, but here is the hidden opportunity. 2 central banks in 48 hours. A Fed that might actually hike. A BoE that is paralyzed by falling inflation and fiscal uncertainty. And a currency pair that is about to explode from its compression coil. I will show you both, the danger and the opportunity. Stay to the end because I am giving you 2 scalp plays and 1 swing trade you can execute today, plus the 1 headline that flips everything. Here is the session bias, aggressively bearish below 1.3340. This market is trending lower across every time frame. Weekly strong sell, daily strong sell, 4-hour strong sell, 1-hour strong sell. That is unanimous selling pressure. But here is what matters most. The single invalidation level that flips this entire structure is 1.3343. Write that number down. If we break and hold above 1.3343 today, the entire bearish structure resets. Now, where is the herd positioned? Retail is long. They have been buying every dip, expecting the BoE to save the pound. But the data tells a different story. Investors raised long dollar positions while increasing short sterling bets in the week ended July 24th. That is smart money leaning into dollar strength, and here is the micro insight that matters. According to CME FedWatch, markets are pricing nearly a 38% chance of a rate hike in July, an unusually high level of uncertainty so close to a meeting. That uncertainty is why the dollar is holding firm and why sterling is stuck. Let us read the chart from the top down. On the weekly, pound sterling to US dollar is neutral but trending toward a strong sell. The pair has been making lower highs and lower lows since mid-July. On the daily, the bearish structure is clear. Price is trading below the 50-day EMA at 1.3367, below the 100-day at 1.3386, and well below the 200-day at 1.3378. Every single major moving average is now overhead resistance. The MACD on the daily is negative at -0.001, and momentum is rolling over. The RSI sits at 42.044, not oversold yet, which means sellers still have room to push. Now drop to the 4-hour. This is where the story gets interesting. The pair is testing a critical support zone between 1.3290 and 1.3300. A successful defense here could trigger a short-term rebound, but if sellers remain in control, the next downside objective is 1.3250 to 1.3270. On the 60-minute, we are seeing compression. The range is narrowing. The ATR is just 0.0079. That is tight. Volatility is coiling like a spring. Here is what most traders miss. The dollar index is holding near a 1-month high at 101.35. The DXY gave up some ground after an unexpected decline in U.S. consumer confidence, but losses are limited amid short covering ahead of the FOMC. This matters because pound sterling to US dollar and DXY have an inverse correlation that is currently running at over 80%. Just this morning, a note from FX Street flagged that the pair is navigating a narrow, highly defensive 30-pip daily range ahead of back-to-back central bank meetings. The 200-hour moving average at 1.3433 continues to slope lower, reinforcing the bearish bias. Key levels to watch: support at 1.3281, 1.3261, and 1.3230. Resistance at 1.3343, 1.3363, and 1.3394. The pivot sits at 1.3312. Now let us connect the macro dots. Because this is where the real trade is. The Fed concludes its 2-day policy meeting on Wednesday. Some major brokerages are warning that policymakers could actually raise rates, given this month's surge in oil prices. Citadel Securities expects the Fed to deliver a rate increase to solidify Chairman Kevin Warsh's inflation-fighting credibility. Meanwhile, oil prices have retreated after the US paused attacks on Iran, and that has eased inflation fears. But yields remain near multi-month highs. Here is the critical insight. According to LSEG data, markets are pricing nearly a 40% chance of a 25 basis point rate increase on Wednesday, up from about 20% just a week ago. Traders see almost a 95% probability of a hike by September. Now overlay the BoE. The Bank of England meets on Thursday. According to a Bloomberg poll of 7 analysts, all respondents unanimously expect the BoE to hold rates unchanged at 3.75%. But there is a catch. 1 or 2 members of the Monetary Policy Committee are expected to dissent and vote for 4%. That is a hawkish undercurrent that the market is not fully pricing. The domestic backdrop does not provide the pound with a sustainable advantage. Recent inflation data came in below expectations, with headline CPI down to 2.6% year-over-year. Signs of spare capacity in the labor market allow the central bank to maintain a cautious stance. The new government's fiscal policy creates additional uncertainty. Rabobank's senior FX strategist Jane Foley highlights how PM Burnham's fiscal choices and intra-labor tensions could affect gilts and the pound. If Burnham can demonstrate fiscal prudence, the outlook for GBP could turn more positive. But realistically, there is significant scope for political friction. Do you think the dollar breaks 105 this week? Comment yes or no. I am tracking consensus. The narrative web is clear. Policy divergence favors the dollar. The Fed is hawkish or potentially more hawkish. The BoE is dovish or at best neutral. The yield spread is widening in favor of the US. And that means pound sterling to US dollar is under pressure. Most people skip this section. That is exactly where the money is made. Keep watching. I have 2 scalping strategies and 1 swing strategy for you. Let us get into them. Strategy 1. The opening scalp. This is a high probability scalp designed for the FOMC pre-announcement compression. We are looking for a structural trigger right at the key intraday level. The setup requires price to tap 1.3260 and print a bullish engulfing candle on the 5-minute chart. That rejection tells us buyers are defending that level. The trigger condition is a 5-minute close above the engulfing candle high after the tap. Entry 1.3265 to 1.3270 to tight stop loss at 1.3245, that is 15 pips below entry. This is a scalp, so risk must be contained. Take profit 1 at 1.3300. That is a 1 to 1.5 risk reward. Take profit 2 at 1.3315 if momentum extends. What instantly voids this scalp? A 5-minute candle closing below 1.3260. That tells us support has failed and sellers are in control. The opening SCLP entry 1.3265 to 1.3270, 5M bullish engulfing rejection, stop loss 1.3245. Take profit 1, 1.3300. Take profit 2, 1.3315. Risk reward 1 minute and 1.5 seconds. TP1 invalidation. Void if 5M candle closes below 1.3260. Strategy 2. The liquidity grab. This is a counter-noise scalp designed to catch the stop hunt that typically happens before major news events. Here is the logic. There is a clear stop cluster just above 1.3310 and just below 1.3260. The algos know this. They will hunt those stops before the real move. We are looking for a fake breakout above 1.3310 followed by a snapback below the breakout candle low on the 15-minute chart. That false break traps the breakout traders and gives us a clean short entry. Entry 1.3305 on the snapback confirmation. Stop loss at 1.3325. 20 pips above entry, just above the fake out high target, 1.3275. That is the nearest intraday liquidity pool and our singular target. Fast in, fast out. Warning. This requires fast execution. If you hesitate, the move is gone. Use limit orders. What voids this setup? A 15-minute close above 1.3315. That tells us the breakout is real, not faked. The liquidity GRAB entry 1.3305, 15M fake breakout plus snapback. Stop loss 1.3325 take profit 1. 1.3275 risk, reward. 1:1.5 invalidation. Void if 15M candle closes above 1.3315. Are you scalping or swinging this week? Comment scalp or swing. I want to see where this community sits. Strategy 3. The session swing now for the swing trade. This is based on the 4-hour and daily bias, designed to capture a multi-session move. The bearish continuation setup. Wait for a 4-hour candle close below 1.3260. That is the critical support level that has been holding. Once we get that close, enter short on the retest of the breakdown level entry, 1.3265 on the retest, stop loss at 1.3315, placed above the daily structure to give the trade room, take profit 1 at 1.3193. That is the major support zone identified by multiple analysts, take profit 2 at 1.3140 if momentum carries us that far. Risk reward on this trade is 1 to 3.2, very attractive, trailing stop rule. Once price reaches halfway to TP1, move your stop to break even. Let the runners ride, explicit invalidation level that would shift the medium-term outlook, a daily close above 1.3343. That would flip the bias and signal that buyers have taken. Controlled the session SONG entry, 1.3265, for H close below 1.3260 plus retest, stop loss, 1.3315 take profit 1. 1.3193 take profit 2, 1.3140 risk, reward, 1:3.2 invalidation, void if daily close above 1.3343 never risk more than 1 to 2% per trade. Scalps demand even tighter risk. I recommend 0.5% on the opening scalp and no more than 1% on the liquidity grab. No positions through high-impact news. Stops are non-negotiable. This is how you survive to trade the next big move. The FOMC announcement is tomorrow at 1400 Eastern Time. Be flat or be hedged 30 minutes before. Let us summarize the single most critical level for the next session. 1.3260. That is the line in the sand. Hold above it, and we could see a relief rally toward 1.3340. Break below it, and we are targeting 1.3193 and potentially 1.3140. Here is tomorrow's wildcard. If the Fed delivers a hawkish hold, keeping rates at 3.5 to 3.75 but signaling a September hike, the dollar will rally and pound sterling to US dollar will break lower. If the Fed surprises with an actual hike, expect a violent dollar spike and a potential test of 1.3230 or lower. But if the Fed sounds dovish, if they signal that the hiking cycle is truly over, then sterling could squeeze higher. That is the tail risk. That is the headline that flips everything. That if this level breaks, the whole monthly trend flips. I will have the updated blueprint 24 hours from now. If you want the full breakdown on Aussie dollar, Japanese yen, Nike 225, those videos are live now on our Alpha Market Meridian channel. Gold, Nasdaq, and Bitcoin are published on the Market Meridian channel. Please click the link at the top of this channel's homepage to access the complete institutional suite. Tap the end screen to jump to the gold melt-up analysis and then loop back to today's Nasdaq gamma flip later. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that matter.